Look at this face. How would you describe it? It's pretty flat, pretty emotionless, right? Now, look at my face. Look at what it can do. Those are all so bad, weren't they?
You don't have to touch your face.
I know, but I don't know. I'm just trying to be expressive. Pretty incredible, right? As humans, we get to experience a wide variety of emotions, and that's what makes us humans and not Vulcans. But here's the problem. Do you see the difference between this and this? Well, first of all, I've got better hair than this dude right here, that's for sure, but not really today. I'm kind of having a bad hair day. No, but for real, the difference here is one of us is full of the spark of life, full of all these really powerful emotions, but the other person is very stone cold and emotionless. So these two things, they don't mix very well. And so today I want to talk about what could possibly be the single biggest mistake that people make as an investor, and that's emotionally investing. If you can avoid this mistake, your odds of being a successful investor will shoot through the roof. I would know, because when I first started investing, I lost a lot of money by investing emotionally. And emotions are running pretty hot these days, understandably so. But I wanted to put together this video to hopefully save you from making the same mistakes that I did. So the very first thing I want to say is that I'm not saying that we should try and control or completely block our emotions, because A, that's just going to be futile, and B, like I said earlier, we're not Vulcans, we're human. Feeling emotions is a wonderful thing. It adds color and vibrance to the experience of life. My birthday just happened on Friday, so I got to feel a ton of really great emotions that day, and particularly in my stomach because of all the yummy things I got to eat. By the way, to celebrate my birthday and me turning 27 years of age, I wanted to share a gift with you guys who I appreciate so much. And so I'll be running a deal on my financial freedom course for 27% off, linked down below. This is your crash course in personal finance that's completely principled, streamlined, broken down into step-by-step actionable takeaways, including exactly how I invest and manage my own money. So check that out and grab it before it's gone. And big shout out to those of you who have been watching since my last birthday. I love you all. All right, so we've established that we're not Vulcans and that birthdays are great. Now I want to show you one of the most interesting graphs that I think when we look at it, we can take so many valuable insights from it and apply them to investing. And I just love talking about this stuff. I really love talking about the psychological side of finance and investing. So I'm really hyped to be sharing this video with you guys. So what we have here is the adoption curve, and this is sometimes also called the innovation curve. And you know how people say, well, a picture is 1,000 words? This is definitely one of those types of pictures here. So this curve basically represents how people react to new innovations. First, we have the explorers. These people are the brave innovators. They're the very first people to adopt a new technology or idea. But as you can see, there's very few of these people. And I think one of the reasons why is because there's a lot of fear and uncertainty around being one of the first few people to adopt something new, right? They're kind of like a guinea pig. There's a lot of risk involved. Think about when the first Tesla came out. So sure, you had some people willing to buy it, but the majority of people were kind of on the fence. They weren't really sure about it. They're like, a fully electric car? I'm not so sure about that. It can't drive as far as my gas-powered car, and where am I gonna charge this thing? And how do we know there aren't any major problems with the car? Nobody's really driving it yet. Well, those early innovators and adopters said, you know what? Yeah, maybe this is a little bit risky what I'm doing. Maybe I could wait for Tesla to kind of iron out the kinks here a little bit, but I don't want to wait. I want to be one of the first people who has this thing. I am so interested in this car. I am fascinated by this new technology, and I think I understand it better than most people. So I have to be one of the first. And so these people are the first ones to jump on board and adopt this new technology, despite the levels of fear at this point being the highest. And then what happens? Well, these early adopters drive the car, they run into problems, those problems start to kind of get ironed out, and talk of this new technology increases. That's when the early adopters start to enter in here. They enter in once things are a little bit more understood, the risk is a little bit lower, and there's a little bit less fear. So what we have here is this curve essentially representing, as we go from left to right, we have fear being the highest at the left, and then fear slowly starts to go away as we move to the right. But not only does the fear drop as we move like that, the excitement also builds. And by the time we reach the exact middle of this curve, right where the most people are adopting the technology, right in the middle of the majority, that's when the excitement is at its very peak. That's why so many people are jumping on board right at that moment. Well, guys, this exact curve plays out in the stock market time and time again. And what you see is people on the left side of the curve are generally rewarded, and people on the right side of the curve are generally hurt. The GameStop situation was a perfect example of this. The originator of the idea for the trade, he was bought in 2019. He was the innovator, he was the early adopter, and so he saw the most to gain from taking that extremely early risk. But by the time we reached Friday 2 weeks ago, that's when we hit peak media. Everyone was talking about it, and that was the point we hit the middle of that curve where the most people were starting to jump in to this trade, right at the tip of the curve and right at the tip of the stock price. And that's primarily because of the emotion that this curve represents. But I mean, hey, I definitely felt really excited when the GameStop situation was going on because I felt kind of a personal connection to that trade in some ways. Remember, I'm not saying that we should try and suppress or control these emotions. We just need to be aware of how they might influence our decision making when it comes to our finances. I actually have one really interesting graph to show you from the Bloomberg terminal that illustrates exactly this point. Take a look at this. This chart from the terminal shows how money moved between GameStop and ARK Invest's massively popular ETF. We can clearly see here that money flowed out of ARK exactly corresponding to GameStop's volume increasing. So this clearly shows excited investors chasing shiny objects. Now, before all you ARK lovers freak out on me, just hang on a second. I love ARK too, okay? I really like what they're doing, as I said in my video that I did on them. My one little nitpick, it's just a little thing I have, is that some, not all, but some people I think are only buying into ARK because of the returns that they've previously posted, just like people were buying into GameStop because of the massive run that it had. Again, some people, not all people, just a little bone to pick. That's it. That's my nitpick. Sue me, okay? So here's what I do to make sure that my emotions don't completely frig up my investments. I set very strict rules. For example, the GameStop situation had me all riled up because for those of you who've been watching the channel long enough, you'll know that I've had personal experiences that leave me with a strong distaste for any kind of unfair financial practices. But I knew that if I was going to buy shares of GameStop, that it was going to be extremely risky and there's probably a huge chance that I was going to lose money. So I made a rule with myself that I would only allow myself to buy one share of GameStop. That one share was enough for me to feel like I was participating. It was enough for me to make a decent gain if things went well, but it wasn't enough for me to cause any real damage to my overall portfolio if that share lost all of its money. So personally, I don't believe we should set super strict rules to completely restrict ourselves because, just like dieting, it doesn't really work for the long term. Instead, what tends to actually work better is to just eat balanced, healthy meals. So the key with making these investment rules, in my experience, is to strike a balance between human nature and the cold, emotionless world of money. As a mostly passive ETF index investor, I'm still a really big believer that there is nothing wrong with setting aside 10% of your portfolio to do whatever you want with it, whether that's, individual stocks, trading, options, crypto, whatever it is. That 10% is yours to experiment with as you choose. That way you have an opportunity to pursue things that excite you or pique your curiosity, so you can have these fun experiments and grow and learn. But at the same time, you're not going to implode your entire investment portfolio. Even if this 10% loses you some money, I still think that it's a net gain, because you're probably going to get some kind of knowledge from that experience, right? Sometimes in life, we have to get a scraped knee to learn things. You don't want to be like that one kid who is just like overly sheltered their whole life, and then when they grow up, they don't know how to take care of themselves at all. But I would be very careful about letting that 10% turn into 20% or 30%. That's where you run into real trouble. Now, anytime you're making an investment decision, it might be a good idea to, keep a copy of that adoption curve and then look at it and then ask yourself, where am I at on this curve right now? Check out the balance of fear versus excitement inside yourself when it comes to investing. Generally, fear is actually something we want to lean into, because it usually means that maybe we're either early into something or that we're going to be buying something at a low price. And then generally, we want to be very cautious about excitement, because it can mean that we're potentially late to the party, or it can mean that we're buying something at an expensive price. Man, I just love money and psychology. It's probably one of my favorite things to talk about it. I could talk about it for days, and that's probably why I talked a lot about it in my course as well, which, just a reminder, is linked down below. 27% off 27, said that weird, to celebrate my birthday going on right now. So grab that deal before it's gone. And also a reminder that, I just appreciate every single one of you watching so much, and you make me feel emotions.